Good afternoon, ladies and gentlemen. My name is Navina, and on behalf of the Sustainable Investment Platform, it is my privilege to welcome all of you to today's webinar. Today's webinar will take an hour, and just to give you a bit of background, it is organized by Capital Markets Malaysia and the Institutional Investors Council of Malaysia under the platform of the Sustainable Investment Platform. So if you have any, it's going to be fairly interactive. It's an hour long, and we have with us two representatives from the Principles for Responsible Investment. And if you have any questions at any time during the session, you can just click on the Q&A button and type your question in there, and it will be displayed for both the speakers to answer. Today's session is about an overview of the global ESG regulations that are out there that impact asset owners and asset managers. And so without further ado, I'd like to welcome James Robertson and Daniel Wiseman from the Principle for Responsible Investment to take over. James, over to you.
Excellent. Well, thank you so much, Navina, for that kind introduction. Really delighted to be here presenting to you all on sustainable finance or responsible investment policy and regulation. And of course, hoping that this session will be informative and useful for you. So just give me one moment and I'll go onto screen sharing and get started. Okay, so Navina, just to double check, can you see the screen sharing clearly?
Yes, I can.
Excellent, great, thank you. So to those of you who haven't joined us for the other events that we've been doing together with Capital Markets Malaysia, this is the third session the PRI has been involved with in our role as knowledge partner for the Sustainable Investment Platform, and it's obviously something we're really delighted to support and really help build further capacity and awareness around sustainable finance and responsible investment for Malaysian institutional investors. The first two sessions we organized were focused initially on responsible investment in listed equity, and then more recently focused on stewardship practices, where the PRI presented on engagement, and we also had a separate event focused on proxy voting. The theme for today's session is, of course, current trends in the global ESG regulatory landscape. And during this session, we'll be introducing what sustainable finance or ESG regulation is. We'll be talking to the different types of regulation and policies that we're seeing developed and issued. And then we'll speak to some of the other trends that we're seeing globally, as well as highlighting examples from some key markets that the PRI is focused on within our policy and research work. So for those of you who weren't present for the past events or may not be familiar with the PRI, we are an investor-led global nonprofit. The goal of the organization is to help understand the investment implications of environmental, social, and governance or ESG issues, and support our members or signatories in incorporating these into investment and ownership decisions. The foundations of the PRI were laid back in 2005 when the UN Secretary General at the time, Kofi Annan, brought together an international group of institutional investors to create the Principles for Responsible Investment themselves. And at the core of the PRI's mission is a belief that a more economically efficient and sustainable global financial system is a necessity for long-term responsible investment, and that it's also going to be of benefit to the environment and society as a whole. And the PRI's mission is particularly relevant to our session theme of ESG regulatory landscape, as the organization works towards this sustainable financial system, in part by seeking to address many of the obstacles that we see to such a system, and they often lie within market practices, structures, and regulation. So the PRI's focus on policy and research has only increased in recent years as we see regulation having a growing influence and role to play. And in past sessions, you may have heard my colleagues or I talk about the mainstreaming of responsible investment and sustainability more broadly, and reference some of the key drivers for this change. Now, before we go into greater detail in terms of policy trends and types, it is worth highlighting that regulation itself has become a key driving force for responsible investment, alongside materiality and market demand. And so just to touch on each of these briefly, materiality, we see this as a growing recognition within the finance industry and within academia that ESG factors can and do influence investor returns. So indeed, because of this potential materiality, we believe that considering ESG issues is part and parcel of fulfilling investors' fiduciary duty. Now, there has been legal analysis from a number of respected law firms to support this interpretation, including some that was commissioned by the PRI directly. But more importantly, we've seen this clarified by regulators in multiple jurisdictions as well. Now, secondly, on market demand, this is of course coming from asset owners and their beneficiaries in particular. So in Malaysia, for example, we know that EPF has increasingly focused on including ESG incorporation within their manager selection, appointment, and monitoring. And we see this being the case with many Asian asset owners, as well as a majority of those in Europe and North America. But then beneficiaries and these asset owners are increasingly calling for greater transparency around how and where their money is invested. And this is driven, of course, by a growing awareness that ESG factors can influence company value, returns, and reputation, but also by an increased focus on the environmental and social impacts of the companies that investors are increasingly invested in. And lastly, of course, and most importantly for today, is regulation as one of these three key drivers. Now, since the 1990s, responsible investment has increased significantly, with a particular surge in policy interventions coming since the 2008 financial crisis. Indeed, government and policymaker interest in sustainable finance has grown even more dramatically in the past decade. So obviously you can see from this chart in front of you, across the world's 50 largest economies, there have been over 730 hard and soft law revisions to some 500 policy instruments, which either support, encourage, or require investors to consider long-term value drivers, including ESG factors. Of these 50 economies, 48 of them have some form of policy designed to help investors consider sustainability risks, opportunities, or outcomes. So you can see very much that this is a growing trend. Now, you may ask, why is this the case? Why is sustainable finance policy on the rise? Well, governments are increasingly aware of the risks and changes that are facing societies. Issues like climate change, biodiversity loss, water scarcity, and among many others that are captured by the UN Sustainable Development Goals. These require significant action and investment to help understand and address these. And so there's that recognition of the role that the financial sector can play. But as sustainable finance and investment policies develop, driving investments towards sustainable, inclusive, and zero carbon economies that we hope to achieve, this requires the alignment of regulatory frameworks, not only nationally, but globally, to help support this shift. So what governments and regulators have been realizing is that sustainable finance and investment can support national policy goals on climate change, on the SDGs. But as well as this, they can also help to enhance economic resilience and stability, improve market efficiency, and increase countries' attractiveness as investment destinations. And so when it comes to sustainable finance, as we'll hear later, we saw initially this being driven by Europe, by North America, with the EU being perhaps the most advanced. But we are also seeing regulators across Asia increasingly focus on these, whether it's in Malaysia, Singapore, but also places like Thailand, Vietnam, and of course, markets like mainland China, Japan, South Korea. So this is really becoming a key area of focus for Asian regulators and Asian governments as they recognize the investment gaps and needs that we have to focus on issues like climate, like the SDGs, like biodiversity and nature. Now, at the PRI, we see sustainable investment policy and regulation is needing to cover 5 areas. So firstly, we have corporate ESG disclosures, which can include the alignment with recommendations of the TCFD, or Task Force on Climate-Related Financial Disclosure. We've got stewardship codes, which can focus on engagement and voting practices and obligations. We've got investor duties, such as to incorporate ESG-related considerations into investment decision-making. Or it could be focusing on providing sustainability-related disclosures or to report on their ESG incorporation policies and performance targets. We've also got taxonomies, and we'll be hearing more around these, but taxonomies of sustainable economic activities, defining common and clear criteria to classify projects or funds or investments as green or sustainable. And lastly, bringing all of this together, we have national and regional sustainable finance strategies that can encourage and enable the low carbon transition and the delivery of the SDGs. In the past, these areas have often been developed and implemented in isolation, in a more siloed approach. However, each play an important role in addressing barriers to a more sustainable financial system. And so these strategies play, national sustainable finance strategies play a crucial role in creating connection and alignment across these different policy areas, as well as signaling a longer-term direction and commitment towards sustainability. I'll now take a few minutes just to go into each of these 5 areas individually so that you can better understand the role they play and how they fit together. So when it comes to corporate ESG disclosures, this is a prerequisite for responsible investment. So the incorporation of ESG-related information within investment strategy, policy decisions, and active ownership activities is regarded by investors and policymakers and as part and parcel of their fiduciary duty. Across markets, regardless of local policy requirements, companies do tend to report on similar ESG topics through voluntary disclosures. But we are seeing a move towards more mandatory and standardized ESG disclosure regulations. And without these, the resulting information can often be incomplete and is not readily comparable across markets, industries, and portfolios. So this can itself be a major barrier for investing sustainably without access to comparable and historical ESG-related information. So national and international ESG disclosure regimes should build on existing and widely used standards, including the TCFD guidelines, and be consistent with the disclosure requirements that are being introduced by the relevant sustainable or green taxonomies, which, as I mentioned, gave you further clarification as what can be classified as green or sustainable. When it comes to stewardship codes, these of course focus on the stewardship or active ownership responsibilities that investors hold, where we see the stewardship as the use of influence by investors to maximize the overall long-term value on which returns and their clients' and beneficiaries' interests depend. So with these codes, they seek to explicitly identify ESG issues as being proper matters for investor attention and place growing emphasis on the role that investors play and the need to formalize stewardship approaches by investors. So stewardship being a key tool both in terms of sustainable finance policy and engaging in driving awareness and performance on ESG risks and issues themselves. We've seen these codes place a growing emphasis on public policy engagement, both by investors and by companies themselves, which can help to encourage policymakers to, of course, adopt measures that strengthen ESG disclosure, strengthen the resilience of the financial system itself, improve the sustainability of the real economy, and encourage greater transparency and allow stakeholders to better scrutinize investors' stewardship activities and compliance. So these stewardship codes can play a key role in driving and encouraging improved active ownership policies by investors in terms of engaging with corporates, but also have a role in driving and encouraging engagement both by investors and corporates with policymakers and regulators themselves. Now, when it comes to investor ESG regulations, these will often be measures that encourage investors to incorporate ESG issues into investment decision making and to encourage them to make sufficient disclosures to beneficiaries and other stakeholders around how they are undertaking responsible investment. So these guidelines can help remove barriers to action by requiring this integration and reporting how we do so. And it can then provide that greater clarity to the market around how investors are undertaking responsible investment, helping to combat the potential for greenwashing. In particular, the definition of investor duties has profound implications for the investment chain. So clarifying that a consideration of material ESG issues is aligned with fiduciary duty has a key impact in terms of decision-making processes, ownership practices, and company management. Now, taxonomies are one sustainable finance policy area that has really only emerged in the last, say, 3 to 5 years. And as we'll hear from Daniel, the EU is or has been one of the leading markets when it comes to taxonomies, but certainly not the only one. Now, what is a sustainable taxonomy? Essentially, this is a classification system which will help investors understand whether an economic activity is environmentally and socially sustainable, and to help navigate this transition to a more low carbon and inclusive economy. So this taxonomy will aim to set a common language between investors, issuers, policymakers, and project promoters, and thus help investors assess whether investments meet more robust sustainability standards and are aligned with high-level policy commitments they may have. So in the long term, it's going to help increase investments that are consistent with sustainability goals, such as creating a net zero resilient and sustainable economy by providing investors that direction on what essentially is green or sustainable. For example, if you are developing an ESG labeled fund, then we see regulators will provide these taxonomies so that you can have a stronger idea of what those funds should be investing in, and going further than this in the EU, for example, having a taxonomy so that all funds, but in particular those that are positioning themselves as green or sustainable, will need to disclose information on the makeup of their portfolios and what companies meet or their activities meet these sustainable taxonomies. Now, lastly, and most importantly, we have national sustainable finance strategies. So these strategies can help to provide a broader national policy framework that aims to ensure that the finance sector supports the goals of sustainable and inclusive growth. So they bridge a gap between the finance sector and the wider economy. And what we find here is that these can and should be well designed and well implemented finance policy strategies that can help to promote this economic development, social inclusion, and to protect the environment as aligned as possible with wider economic strategies. They can support and enable investment in areas that require capital, particularly where governments are unwilling or unable to do so. And they can enable or accelerate this country's ability to deliver on sustainability-linked goals, such as climate targets or the SDGs. So, for example, whether energy subsidies and taxes which support fossil fuels or renewable energy can be a critical determinant of whether a country achieves its national greenhouse gas targets. So, each of these policies has a key role to play in addressing a barrier or area of sustainable finance that we need to move forward. And these national strategies can bring all of these together, providing a longer term signaling or direction of what the country's commitments will be, and aligning both the sustainable finance strategies, so bridging the finance sector and the wider economy together. Now, I'm going to hand over to my colleague Daniel now to speak to some of the key trends that we're seeing within sustainable finance policy. Daniel, over to you.
Thank you, James. My name's, as James mentioned, my name is Daniel Wiseman, and I'm head of Asia Pacific Policy at the PRI. As part of our global policy team, I lead a team of policy analysts engaging with our signatories, regulators, and governments across the APAC region. So I'm now going to talk about a few key trends that we're seeing and highlight some key market developments in some of the most influential jurisdictions that we look at. So picking up on James's last slide and some of his comments, one of the key trends that we're seeing is that over the past 2 decades, there's been a very significant move from the piecemeal adoption of different strategies and policy interventions targeting ESG related issues and sustainability related issues, and a move really to more towards comprehensive national and regional level sustainable finance strategies. These national sustainable finance strategies have been characterized by comprehensive reviews of jurisdiction-specific financial market practice and regulation, and deep analysis of the most strategic intervention points to help financial actors both manage ESG risks and also, importantly, to contribute to ESG sustainability outcomes and impacts. I think one of the unique aspects of these developments that's worth mentioning is that, and it's a point we'll come back to later, but a lot of this has really been driven and developed by very close collaboration with industry and finance professionals in each of the major markets. So as you can see highlighted on this slide, for example, in the EU, we've had the high-level expert group on sustainable finance, which has led to the development of the EU Sustainable Finance Action Plan and fed information into the EU Green Deal. And that's very much been led by industry and supported by investment professionals being closely involved, both directly and through industry associations in setting the goals and objectives of some of the sustainable finance policy. We've had the same situation in the UK with the Green Finance Task Force, which in turn has led to a whole of government green finance strategy. And we've seen similar developments in China with the establishment of the Green Finance Task Force there, which goes back all the way to 2014 and involved over 40 experts from across industry, financial regulators, academics, and with many findings of this group having made their way now into official government and regulator policy in China. What's not so well represented on this slide, perhaps, there is the note about Australia, which there's similar industry-led initiatives happening there. And then in the last 6 to 12 months, we're seeing the same sorts of developments in the US with comprehensive market-wide sustainable finance, and particularly focused on climate change in the US, strategies being developed by financial regulators. The other development in relation to this that we're seeing with these very strategic and comprehensive national sustainable finance strategies is that they're also becoming more closely integrated with economic policy and government spending strategies. I'll now go to the next slide. Thanks, James. So in terms of a few other key trends that are worth pointing out, and in terms of where these policy developments are happening, I think this chart provides a useful overview. This data here is from our global regulation database, the findings of which are all available online. And it summarizes a detailed mapping that the PRI has done and a detailed research program summarizing responsible investment policy developments around the world over the past 20 years. As you can see, it clearly shows that Europe has been leading the way when it comes to sustainable finance policy interventions, and that this has grown a huge amount in the last decade. However, as you can see from the slide, the Asian market in particular is really starting to catch up. And given the wide number of jurisdictions across the Asian market and the wave we're seeing of recent policy developments, we expect this trend is likely to accelerate very significantly in the near future. And I think with the signaling from the new administration in the US, we're also likely to see a significant uptick in the findings from this survey in our 2021 results in relation to the US as well, both over the past 12 to 18 months, but going forward as well. We expect these trends to continue, perhaps with Europe out the front for the time being, but with other parts of the world increasingly catching up. And the next question, I'll go to the next slide, is what types of policies we're seeing. So beyond the high level, one of the other pieces of data we've obtained from our research is exactly what sort of sustainable finance policies and regulations are the majority of what is being produced. And this chart that you can see here categorizes the different types of policies in our database by type. As you can see, corporate ESG disclosure requirements are by far the biggest slice of the pie. I think this is hardly surprising given that the information provided by disclosure, as James mentioned, is really the fundamental building block that all other sustainable finance policy developments rely on. So it absolutely makes sense that this has formed the basis of the majority of sustainable finance regulations so far. But that being said, I think as you can see, there's increasing, there's a large slice of the pie in relation to investor ESG disclosure requirements. Again, another important building block. Then ESG integration by investors, stewardship codes, and taxonomy related regulation, which are the key elements that James has already talked through. One trend which isn't actually illustrated on the chart here and we're observing currently, however, is that the growth in the number of corporate ESG disclosure policies in comparison to other sorts of sustainable finance regulation has started to slow down. And at the same time, we're seeing a huge increase in the number of investor ESG disclosure regulations, which are up over 2019 by 74% from 2019, and investor ESG integration policies, which are up 100% from 2020 this year. So from our perspective, that's a clear evolution of the ESG policy landscape maturing. The other sign of that maturity, I think, is an increasing rise in sector-specific policy instruments. So we're seeing not just general requirements, but very specific and tailored regulations targeting different sorts of actors across the investment chain. So including banks, insurers, asset managers, pension providers, sort of the core market actors, but also increasingly service providers like investment consultants, auditors, actuaries, proxy advisors, index providers. All of these different market participants are increasingly being subject to very specific and targeted financial regulation, encouraging them to integrate ESG or sustainability factors into their work and advice to their clients. With the next slide, and this is just one further chart I'd like to share before providing some specific examples from some of the key markets we're going to look at. So this chart summarizes the distribution of mandatory versus voluntary policies that we see in our database. And it illustrates the extent to which new responsible investment policy has been introduced on either a voluntary basis or a comply or explain basis, and on the other hand, a clear mandatory basis, which requires actors to actually take steps or face certain penalties. And as you can see, over the last 10 years, the proportion of policies that have been introduced on a voluntary basis has actually increased quite significantly. And I think part of the reason for that is as there's been innovation and development and increasing expectations tied to existing market practices, regulators have wanted to provide optionality to market participants about how and to what extent they integrate ESG issues, risks, and impacts into their decision-making. But what we're also seeing is that voluntary policy is also increasingly a stepping stone to hard law down the track. And in recent years, the trend of increasing voluntary regulation has actually plateaued as the next generation of sustainable investment law is increasingly being introduced on a clear mandatory basis. So going forward, as market and policy practices mature, I think we again expect to see an uptick in mandatory policies, especially in relation to some of the core expectations and requirements now in relation to ESG disclosure and ESG integration. While at the same time, some of the new generation policies, which are going beyond ESG integration to support investors to pursue sustainability outcomes and impacts in their own right, this sort of next generation of expectations may continue to be voluntary for now, but over time we would expect to see the same trend in terms of a plateau of the voluntary approach and a move towards mandatory as the market becomes more mature and market actors understand exactly what they need to do to embed these activities into their work. So I'll now move on and provide some more concrete examples about the recent developments, and we'll cover a few key markets. I'll speak to the EU, the US, and China, and James will cover Hong Kong and Singapore. And in terms of summarizing this, there's a huge amount happening in this space, but we've broken these down into the five key elements that James has already spoken to for responsible investing policy. So we'll cover the extent to which these markets have national strategies, the extent to which they have clear ESG disclosure laws for corporates. We'll look at their investor duties, requirements around integrating or considering ESG factors. We'll briefly mention stewardship-related interventions and also cover points in relation to the taxonomy. And what we'll be providing certainly won't be a comprehensive overview, but should give an idea of where each market is at. And as you'll see, there's a huge amount happening in this space. So we'll start with Europe. And I think it's fair to say this is, as we've already seen, the European market is really driving a lot of the agenda around sustainable finance. And the activities, the regulation, the policy developments that are happening in Europe are also influencing strategies and developments in countries around the world. So very important to look to in terms of seeing the direction of travel going forward as well. So at the national strategy level, and I think this is where the EU has perhaps been most innovative, back in 2016, the EU set up this high-level expert group on sustainable finance, which I've already mentioned. It was comprised of 20 senior experts from civil society, the finance sector, academia, and it was mandated to provide advice to the European Commission on how to steer the flow of public and private capital towards sustainable investments, and to identify the steps, the really concrete steps the financial institutions and their supervisors should take, both to protect the financial stability and the integration of ESG risks, but also to support broader EU sustainability policy. So following the recommendations from this expert group in 2018, the EU adopted the first version of its European-wide Sustainable Finance Action Plan. The plan set out a comprehensive strategy to further connect finance with sustainability. And it included 10 key actions across 3 very broad categories. These 3 categories included reorienting capital flows towards a more sustainable economy, and that included expectations and requirements around the development of the EU taxonomy for sustainable activities, which I'll come back to shortly. The second broad category focused on mainstreaming sustainability into risk management. So that included clarifying asset managers and other institutional investors' duties regarding ESG and sustainability issues. And third, the third broad category it focused on was fostering transparency and long-termism. And this really included focusing on strengthening sustainability disclosures for corporates and investors alike, as well as updating accounting, rulemaking, and audit and assurance requirements as well. So that was the first generation of the EU Sustainable Finance Action Plan. And a number of the requirements that I'll mention subsequently have developed out of this. But in June 2021, so very recently, we've had the update to this initial action plan in Europe, which is even more ambitious in its objective to help very specifically align the finance system with sustainability goals. And interestingly, this second iteration of the strategy has also been very aligned with the EU's broader policy objectives and the EU Green Deal, which was announced in 2019. So there's really a focus on increasing the complementarity and alignment between real economy policy, national spending, so EU budgets, and sustainable finance policy, and having all 3 of these different strands working together to mutually support each other. So with this new plan, it aims to enable investors to reorient investments towards more sustainable technologies and businesses to help support the EU in reaching its climate, environmental, and social targets. So it's concerned not only with mitigating risks to the financial system, but helping harness the power of the financial system to support the EU's broader sustainability goals and policy targets. Among other things, it includes a plan to publish a report on a social taxonomy, so going beyond just environmental issues. It includes requirements around better integration of sustainability risks in risk management systems of banks and the prudential framework for insurers, and to further clarify the fiduciary duties and stewardship rules of investors to reflect the financial sector's contribution to Green Deal targets. So that's the overarching national strategy landscape in Europe, which I spent a bit of time on just to paint the picture of how really whole economy this is. And I'll go briefly through some of the other requirements now. So in terms of disclosure, there's been expectations around corporate disclosure and sustainability in Europe since back in 2014, where there was the introduction of the Non-Financial Reporting Directive, which required reporting against environmental, social, human rights, anti-corruption, bribery issues, as well as diversity on company boards. And that's been in place for a number of years. There were widespread criticisms about the quality of company reporting, and particularly concerns by investors and our signatories, including as part of that in terms of the quality of information that was being provided. So in 2021, we've had an updated version announced, which is the new Corporate Sustainability Reporting Directive, and that includes much more detailed requirements around exactly what sort of sustainability information is required to be disclosed, and sets up a new system of EU-wide sustainability reporting standards, which will come into effect over time and which corporates will have to report against, as well as having to report in relation to their activities in relation to the EU taxonomy. In terms of investor duties, as you can see from the alphabet soup of regulations on the slide, there's been clarification across a wide range of regulations and directives covering different ESG, covering different investors' requirements. And these now require investors from pension funds, asset managers, insurers, different sorts of fund providers to clearly integrate ESG risks and impacts into their decision-making. These sorts of requirements are backed up by some increased disclosure regulations and also supported by the Shareholder Rights Directive, which now requires consideration of ESG risks as well as impacts explicitly in investors' stewardship decision-makings, and including some quite significant transparency requirements around these. Finally, the taxonomy, which you may have heard something about, was finally introduced in the start of 2020, and this is a very significant innovation that the EU is pursuing, which really clearly for the first time sets out an extensive classification system, establishing a list of environmentally sustainable economic activities aligned with climate change and broader environmental goals. The technical screening criteria is currently being considered and includes a detailed list of economic activities which will be considered to be sustainable. And this is also linked to some of the broader investor duties and corporate disclosure requirements. So in summary, in terms of Europe, a huge amount is happening at the EU level. One of the key characteristics is to focus on sustainability, objectives and outcomes as an important facet in their own right, beyond just financial risk and return issues, which is, I think, a development we're seeing in other markets increasingly as well. So I'll now move on to the US. In the US, we really have a tale of two different eras at this point. In terms of this responsible investing policy and sustainable finance, I think we saw very little action in this area during the Trump administration, perhaps not surprisingly. And then in recent times, a huge rush of action with the commencement of the Biden administration, really wanting to get up to speed in terms of its oversight of sustainability and ESG risks by financial markets. So at the national level, we've recently had the Financial Stability Oversight Council. They've issued their report on climate-related financial risks. This includes over 30 specific recommendations to US financial regulators, laying out necessary action to identify and address specifically climate risks to the financial system and to promote the resilience of the financial system to those risks. This is characteristic of a lot of the regulation in the US. It's more narrowly focused on climate change rather than some of the broader goals at the EU level and in some of the other markets. This has also been supported by activities with some of the other financial regulators, including the Commodity Futures Trading Commission, which is an influential regulator in the US, which has also developed a working group on climate-related risk and looking at how these issues will be integrated into its work. So that's the overarching strategy picture. In terms of disclosure, we have had the SEC commissioned guidance all the way back in 2010 about the need for companies to disclose material information in relation to climate change. And that's, I think, given rise to a huge amount of quite high quality disclosure across the US market on this issue, even despite some of the regulatory developments in the intervening years. And currently we're waiting for a proposed SEC rulemaking, which will update this finding and make more specific requirements about climate-related disclosures. In terms of investor duties, we've had the Department of Labor come out quite publicly recently in terms of requirements for pension plans. During the Trump administration, there was a big pushback against the presumption that ESG was material. And most recently, we've seen a consultation currently with the Department of Labor going back the other way and making very clear rulemakings that ESG is material, and to the extent that it is, needs to be taken into account in investors' activities. And we've seen exactly the same thing in terms of stewardship. So there's current consultations underway to clarify the importance of ESG and climate change to proxy voting and broader stewardship activities. Finally, on the taxonomy, the US doesn't have a taxonomy of its own as yet, and there's no coordinated regulatory action around this. However, the CFTC, which is an influential regulator, has recommended the development of a taxonomy in the future, and we understand this is something that's being looked into by industry and others. So finally, before handing over to James, I'll just cover some of the developments in China, which is obviously one of the other key markets where there's a huge amount of developments in terms of green and sustainable finance. I think in terms of China, not surprisingly, these developments have been guided by China's particular market dynamics and political objectives. And given the strong focus on direct government investment in China and the importance of the banking system, a lot of the initiatives to support green investing have really started at the institutional government policy level and focused quite heavily on guiding the banking sector and bond markets. Although broader application is starting to occur. So at the national strategy level, we've, back in 2016, the People's Bank of China established guidelines for establishing a green financial system, which has really set the agenda going forwards. The Green Finance Committee, which coordinates activities across a range of the different regulators in China, is still very active in developing some of that work and leading research across the different financial regulators on this issue. We've now seen increased expectations around corporate disclosure with requirements through the Environment Protection Law, updated requirements from the CSRC, which is the securities regulator in China, and the stock exchanges in China also providing guidance on disclosure around ESG and CSR issues. In terms of investor duties, again, we have increasing guidelines from some of the key industry bodies and regulators, including the Asset Management Association and the Ministry for Ecology and Environment, paving the way with clear guidance around regulations for investor duties. In terms of stewardship, I think this is perhaps less developed in China than in some other markets, but we understand that the Insurance Asset Management Association and the Asset Management Association are currently in the process of developing and looking at a potential stewardship code for China, which could potentially also include ESG related issues as well. And then finally, in terms of the taxonomy, we don't have an economy-wide taxonomy, but we do have the very active China Green Bond endorsed project catalogue, which is effectively a taxonomy for green bonds. And China and the EU are now doing a lot of work to identify and prepare a common ground taxonomy, which will help provide coordination and interoperability between the EU taxonomy and the China Green Bond catalogue, which will be an important development going forward as well. I'll now pass over to James to cover a couple of the other key markets.
Excellent, thank you, Daniel. Well, I'll just spend a few minutes, just very wary of time, on Hong Kong and Singapore respectively. Now, Hong Kong, of course, plays a crucial role as one of the region's leading capital markets, but also as a gateway to China. And so it's been looking to support policy commitments and position itself to help enable the advancement of the policies that Daniel has just referenced being advanced in mainland China. And this is in part why much of the development in Hong Kong has been framed around green finance in the same way that mainland has, with a stronger focus on climate rather than on broader sustainable and responsible investment. A key development in Hong Kong has been the establishment of the Green and Sustainable Finance Cross-Agency Steering Group back in early 2020. So this has essentially brought together all of the main financial regulators, as well as the Environment Bureau and other stakeholders on the government side. And this group has really worked to put in place a more long-term and strategic national strategy for Hong Kong when it comes to green and sustainable finance. They published their initial plan in 2020, and some of the key priorities, there are 5 which are identified, include ensuring TCFD aligned disclosure to be mandatory no later than 2025, a commitment to adopt the common ground taxonomy that Daniel has just referenced, and as well a commitment to support the International Financial Reporting Standards Foundation, their proposal to establish a new sustainability standards board. So this is essentially developing a more global framework for corporate reporting and a more uniform set of sustainability reporting standards going forward. So this is still an initiative that's under development. So at a national level, they have identified a number of priorities, particularly around TCFD, around taxonomies and reporting. And they've been working closely with another group, which is the Hong Kong Green Finance Association, which is primarily an industry body established back actually a number of years previously to help bring together participants to build capacity and propose suggestions to government and regulators on green and sustainable finance. Now, when it comes to other entities, both the Hong Kong Exchange and the SFC, the main securities regulator, have been front runners in Hong Kong. The SFC launched their strategic framework for green finance back in 2018, and this included actions around the management of green or ESG funds. So those labeled funds have specific criteria put out by the SFC in terms of reporting and disclosure standards they need to make. So making sure that there is appropriate transparency around how these funds are actually green or ESG. We've also seen the SFC more recently amend their fund manager code of conduct to bring in requirements around the management and disclosure of climate related risks. So as Daniel mentioned earlier, climate really becoming a priority for investor disclosures. And Hong Kong Exchange themselves having ESG reporting requirements in place actually since 2015, comply or explain disclosure requirements there. Most recently in 2020, they put out for consultation and strengthened requirements for board in terms of managing climate-related strategy and climate-related risks. So we continue to see this in this space developing quite quickly in Hong Kong. Certainly the SFC and the Hong Kong Monetary Authority, the banking regulators, were moving faster on this. But more recently, we've seen the MPF authority, so the pensions regulator, update their guidance for trustees around ESG and sustainable finance. And we also see the insurance authority really focusing in on developing guidance for their members now as well. Obviously, Hong Kong and Singapore both jockeying to be a leading green or sustainable finance hub across Asia. And I think both have been moving strongly on this, as well as Malaysia since 2018 and 2019. In Singapore, the Monetary Authority of Singapore, so MAS being the main regulator there, they developed a green finance action plan, first launched in 2019 and strengthened in 2020. There were 4 areas here. So firstly, strengthening financial sector resilience. Secondly, looking at developing markets and solutions. This included establishing a green and sustainable bonds and loans platform and grant scheme, and a green investment portfolio that has been awarded to a number of asset managers earlier this year. The third was looking at harnessing technology. And the fourth area was looking at building knowledge and capabilities around green and sustainable finance To support these priorities, MES convened the Green Finance Industry Task Force. Again, so we're seeing the involvement of key stakeholders and financial institutions supporting regulators in developing this work. And the GFIT has four areas of focus. Firstly, developing a sustainable taxonomy for Singapore, something they put out, proposed a green taxonomy under consultation earlier in 2021. Looking at enhancing the environmental risk management practices of financial institutions. And actually in late 2020, we saw MES issue guidelines on environmental risk management for insurance companies, for banks, and for asset managers, respectively. So these including climate change, but also being broader than climate when we're looking at environmental risks. The GFIT is also to focus on improving disclosures, and more recently we've seen SGX, although they've had sustainability reporting guidelines since 2011 and these were updated in 2016, earlier in September of this year, we saw them consult both on a process and a roadmap to climate-related disclosures to be completely mandatory, but also including some consultation requirements around board diversity. And so we expect these to come into place from 2022. So SGX working on this for some time, slowly ramping up requirements. MES, of course, driving this very strongly, as well as working alongside the Green Finance Industry Task Force. And when it comes to stewardship, we had Stewardship Asia, which is a body set up by the MES and supported by them, but independent of MES. But essentially, Stewardship Asia issued the Singapore Stewardship Principles back in 2016, and these are actually currently under consultation to be updated at the moment to develop a Singapore Stewardship Principles 2.0, where they'll be looking at revisiting the definitions of stewardship, the considerations of ESG issues into stewardship practices, as well as on the outcomes of stewardship. So these are just some of the key developments we're seeing both in Hong Kong and Singapore as Asian financial centers really start to focus in on green and sustainable finance and consider what are the key regulatory steps they need to put in place to help develop themselves as a key capital market for investors in this area. Now back over to you, Daniel, just to talk to some of the final key trends we're seeing.
Thanks, James. I'll just spend 20 seconds on each of these. So the first key trend is the role of investors in policymaking. And I think, as I've said, this has become a huge focus for investors and certainly our work in supporting signatories. And for those who are interested, the PRI has a global policy reference group where we encourage signatories and others to get involved in policy work and a collaboration platform to support signatories and investors to do so. So I'll go to the next slide to cover the next key trend very quickly. And that's just in relation to climate change and the TCFD. As James has mentioned, climate change is clearly at the top of the sustainable finance agenda, and TCFD aligned disclosure requirements is a core part of that. It's happening across a whole range of jurisdictions, and it's increasingly included on a mandatory basis. Finally, in terms of the last key trend I'll mention is that real economy outcomes are really the new focus for investors and policymakers, not just considering ESG risks from a narrow risk and return perspective, but looking more broadly at what sustainability outcomes and impacts investors should be considering in their actions and activities. So I'll wrap up there and pass back to James.
Excellent. Thank you, Daniel. So again, if anyone has any questions, we'll keep an eye on the Q&A, and we should hopefully just have a few minutes just to address those if there are any. But really, to conclude from our presentation today, what we see as the 5 key trends that investors should be aware of. Now, of course, this is first and foremost that sustainable finance policy matters. We are seeing this in Malaysia, we're seeing this across Asia, and we're seeing this globally. As we've mentioned, the number of both hard and soft law policy instruments and revisions is significant, and year on year, we see more and more sustainable finance policy instruments being introduced. So this is a trend we expect to continue as investors are provided and require greater clarity from regulators in terms of what is required of them and what they can and cannot do. We're also moving from this more sporadic adoption that we've talked through earlier to a more comprehensive approach guided by national sustainable finance strategies. And of course, the strength and depth of those strategies themselves does vary by country. So I think probably the EU is the most developed strategy we've seen so far. But these play a key role in bringing together often a more siloed approach to sustainable finance policy making that we've seen in the past, and creating much greater cohesion across and amongst these different instruments. The third trend here is that investors are increasingly playing a role here in public policy development and implementation, and this may be through increasingly engaging and responding to consultations that are being put out by regulators, but there's also the opportunity to contribute through industry groups that are being developed. As I mentioned, we've seen this in Singapore with the Green Finance Industry Task Force, in Hong Kong with the Hong Kong Green Finance Association, which are platforms that provide an opportunity for investors and other stakeholders to have a say and a voice in the sustainable finance policy being developed, and play a role in developing this itself. And of course, we see this in Malaysia as well through the group that's been set up by Bank Negara Malaysia and the Securities Commission Malaysia with regards to climate. We are, of course, getting more technical and implementation focused in terms of the sustainable finance policy, and that's something that is, I think, increasingly required as we see RI move into the mainstream. And lastly, a focus on real economy outcomes. And this is something I will admit is being driven more by investors and I think regulators in North America, in Europe. But increasingly, I think we're seeing regulators and governments in Asia and emerging markets start to focus on real world economy outcomes, again, recognizing the investment gaps or flows that are required to help meet some of these national targets, whether they're climate related, SDGs or otherwise. So thank you all for listening. This is what we see, or these are what we see as some of the key sustainable finance regulatory trends that you should be aware of. And hopefully it's given you both an overview of what these different instruments are, but what we see happening in key markets, as well as the direction we see this moving. So I'm going to stop there. Our slides and a recording of this presentation is going to be made available to all of you. But if anyone has any questions, now is the time. And I see we have one question that's come in, and maybe Daniel, I think we probably touched on some examples here, but a question from David is, are there any investor ESG regulations to combat greenwashing that has been implemented in any country's jurisdiction?
Thanks, James, and thanks, David, for the question. So I think what we are seeing is not so much specific regulations targeting greenwashing, but clear statements from financial regulators in different markets that they're going to use existing legal requirements and regulations around fair and honest disclosures and transparent information to really start to look at and investigate concerns around greenwashing. So I'm aware of this clear statements at the EU level, at the UK level, from the Financial Conduct Authority. I know the SEC in the US has elevated this as a priority issue. So there's clear interest and concern from financial regulators around the world to use their existing, I guess, regulatory toolkit to address some of these issues. So I think that's the most likely way this is going to be dealt with going forward. And as the market matures, it's becoming increasingly important that investors can support their claims with evidence and information around the extent to which they have actually, in fact, integrated ESG or sustainability issues into their activities. And I think that level of rigor and expectation is going to increase as well.
Yeah, absolutely. Thank you, Daniel. And I think that's where, the roles of having taxonomies, for example, these other policy instruments do play a part here in enabling investors to undertake that disclosure and transparency around how they're approaching sustainable finance, what it means when they are saying they have an ESG or a green fund. So being able to really look under the hood, as it were, to understand how this is actually being done in practice and increase those expectations of investors around disclosure and transparency. So if there aren't any other questions coming in, then aware that we've just gone a few minutes over time, we'd like to, of course, I'd like to thank Daniel for joining us to help share his expertise and insights. And of course, thank everyone, all of you for joining. As Daniel alluded to, there's a substantial amount of resources on the PRI website, including a global policy regulation database that you can look up if of interest. And if you are a PRI signatory, we also have the PRI's Global Policy Reference Group that you can look to join to be kept more aware and engaged in terms of sustainable finance policy developments. So if you are a signatory and that's of interest, please don't hesitate to reach out to me. Otherwise, I will end there and hand back over to our hosts to close the session for today. Thank you so much.
Thank you so much, James and Daniel. That was really comprehensive, a great account of all the various ESG regulations globally in key financial markets. Ladies and gentlemen, that brings us to the end of the session and also the final session for the SIP this year. We will be back next year with a slew of other topics and webinars, and we hope to see you then. Till then, goodbye.